Concerns over the stability of financial systems back in focus. Shares of Silicon Valley Bank, also known as SVB, nosedove yesterday, causing a ripple effect for the global equity markets. They're now halted, and CNBC is reporting it may be looking for a sale. And while Reuters reports employees have been asked to work from home, now Fed policy, of course, playing a big role in all of this, but exactly how? That's a key question. And Yahoo Finance's Julie Hyman can help explain. Julie, help explain.
I'm going to try here to explain how rates are playing a role in all of this. Basically, it has to do with the assets that SVB held on its balance sheet. Apparently, the company was forced to sell treasury bonds as well as mortgage-backed securities. It sold them, reportedly, according to what we're kind of teasing out from the situation, because it needed to raise capital, because its clients, venture funds, startups, etc., were withdrawing money. The company needed to raise money, and so did a sale. It did a sale at a loss. And what is the Fed's impact on those assets that it held on its balance sheet, like treasuries? Well, of course, bonds are very sensitive to interest rate changes. The Fed has been raising interest rates. The market price of existing bonds drops, and the yields go higher, and then new bonds come on the market on higher rates. Banks are not required to write down the value of these types of assets on their balance sheet until they sell them. And so large banks, for example, which tend to be better capitalized and don't have as many withdrawals that they need to then raise money, they're in a better position. They don't need to write down the value of these kinds of assets. There are a lot of bonds on bank balance sheets broadly, $2.2 trillion. That's according to the Wall Street Journal, which cited data from Fed filings here. And so that's why you're seeing this concern in the market right now. Again, when banks sell these bonds, they recognize them as losses on their balance sheets, but only when they sell them. SVB was forced to sell about $21 billion worth of Treasury securities at substantial losses. And then SVB said it was issuing shares to raise money and cover those losses. And that's what raised alarm bells across the investment space. Here is a look at growth in unrealized losses. This data dating to September 2022. If these banks hold these treasuries until maturity, there's not necessarily this issue, because then they collect the full coupon and they don't have losses. At least that's my understanding. Jared, Blikre, if I have that part right, correct me if I'm wrong.
Do they collect the coupon? I mean,
in other words, the reason that they had to mark these down is because they sold them before maturity.
Oh, yes.
If you hold them to maturity, I don't think there's the same kind of write-down, even because there's no write-down to present value, right?
Exactly. So if you think about it this way, a bank has on its balance sheet assets and liabilities, and the assets are what it's loaning out to other people. So if somebody owes money to the bank, that's an asset. If the bank owes money to somebody else, that is a liability. So let's say you have depositors here. Depositors withdrawing their money, there's not as much money there, so the bank has to sell money, or has to sell some of its bonds, like treasury coupons and treasury securities, in order to fund that. Well, if they need to raise that money and the value of those bonds have gone down, they realize those capital losses. Had they held those to maturity, as you're saying, Julie, would have been no problem there. But this gets back to treasury market volatility, and this is something that reared its head in the late 70s and the early 80s while Blikre was at the Fed, and then Greenspan. This is something that banks had to deal with back then, and it's been almost 40 years since then. And so we don't really have a regulatory structure that's in place that allows us to deal with these kinds of things.
Right.
So as I was saying a few hours ago, this seems to me like a kind of a slow motion train wreck. We're probably going to see these little pockets of instability, but not necessarily systemic risk.
No, not necessarily systemic, because we know a lot of these banks loaded up on these kinds of securities over the past few years, but most of them most likely are not going to be forced to sell them.
Yeah, I would agree there. It looks like, and the Fed has a lot of wiggle room. We're talking about, are they going to go to 25 to 50 basis points? But we'll see how this unfolds here.